Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Phil Snyder. This is BRN AM for Thursday, March 31st, 2022. And our top story today, how does life insurance fit into a retirement plan? Joining me now to discuss this and a lot more, Phil Snyder is a Senior Vice President with the L. Warner Companies, Inc. And he's also my father, so full disclosure there. Dad, Phil, thanks so much for joining us on the program this morning.
Oh, hi, Jeff. Good morning. Happy to be here.
Yeah, it's great. And again, no sales pitch here. We're just hitting the facts. Let's talk about retirement. People know the 401k. They know an IRA, and there's all different types of IRAs, right? The SEP, the KEO, all that kind of good stuff. They know Social Security. They know their pension if they're lucky enough to have one. But life insurance is also a vehicle that can be used to draw down for retirement. How do you see it?
Well, all right. Let's talk about the properties of cash value life insurance, because that's really what you're talking about. How can we use an insurance vehicle to build cash that could be used as well for any purpose in the future, but looking to retirement funds that could be made available in retirement? Life insurance, permanent life insurance, that is what we used to call whole life insurance, but now comes in many other forms, has three very advantageous tax properties. One, and I think most people know this, death benefits paid under a life insurance policy are free of income tax. That's point one. Point two, a cash value life insurance policy accumulates cash and the earnings on the cash on a tax deferred basis. So as money is growing, there's not current taxation on that money. And thirdly, and this is maybe the most important when we talk about retirement benefits, cash value that's built up over the years can be accessed and withdrawn from the policy over a period of time on an income tax-free basis. So you have a unique property in terms of getting money out of what could otherwise appear similar to a Roth IRA, but without the constraints of a Roth. You could get money out at the back end in retirement, income tax free. So those are the properties. And then the question becomes, well, how do we do this? And how does this form let's call it a separate asset class, if you will, in your retirement planning? So we're certainly not talking about putting all your eggs in one basket. We're saying a permanent life insurance policy, if funded properly over one's working lifetime, could produce additional income in retirement as a supplement to all the other qualified plans or other forms of savings that you've accrued during your working years, looking to build a meaningful retirement benefit.
And I should point out, so just to clarify or get you to clarify, we're not talking about annuities, fixed or variable annuities. That's a different vehicle. I forgot to lump that in with the retirement vehicles. We're talking about what used to be called whole life insurance, not term life insurance. So you're contributing premia into a vehicle like this whole life insurance. Now, do you select the investment or investments like you would in a 401k plan? So money gets invested. Does it get invested in like a equity vehicle or a fixed income vehicle based on the insured?
Well, there are numerous types of choices of policies that are available. Whole life insurance, which has been the bellwether of the industry for 100 years or more, is essentially a fixed premium product that builds in cash value within the policy on a predetermined basis, and for the most part would distribute a dividend that would enhance the return over time. I'm not going to get into all the background of what the dividend represents, but that's a form of insurance. What's evolved in the last, 30 to 35 years is a flexible premium policy. Generically, it's called flexible premium adjustable life. The industry calls it universal life. And those type of products allow you to either select a product where the insurance company credits a rate of interest to your money in the policy based upon its portfolio rate of return, or you can, I should say, and/or you can find a product that allows you to select from an array of investment accounts within the policy that could look like mutual funds. They could be index funds. They could be growth funds. They could be international funds. They could be bonds. They could be any combination of all of these that suits your risk tolerance and fits into your long-term objectives. So there's a whole array of products out there that are available. And you really need to find the right product. Well, first you need to find the right advisor who can properly advise you on which products are suitable for you and help you to understand how these products work. So there's no automatic fixed solution to this. It's a concept that should be explored.
So Dad, do I need to be Phil? Excuse me. I'll call you Dad. I don't care.
That's all right.
Let people write in.
Happy to be your dad.
I mean, it is a true statement. You're Phil and you're my father. But yes. Dad, do you need to be a wealthy person to do this? I mean, I think people out there who have looked at term life and looked at whole life know that there is a distinct difference in the premia that you pay, because one has a cash value, one doesn't. But does a person need to be an uber wealthy person to do this? I mean, it seems to me that there are real benefits to cash or whole life or universal life, where there is a cash value that maybe people who are using a term life product maybe aren't thinking about on the back end.
Well, you have to have the ability to pay the premium and put money into these policies. So for those people who are living on a fixed budget, it may not be realizable, at least in the short term, because they're going to have other expenses and so forth. So I would not call this an affluent person's concept, although the affluent certainly can take advantage of this. What you really need to do is to find a comfort level to place money consistently in a policy and let it grow over the years. And you can start small. With whole life policies, they're a little less flexible, so you can't really alter the premium over time in those products, whereas flexible premium policies you can. So you can start out with a small amount of contribution, and as your distributable income, after tax income, grows, you can put more money into the policies and let them grow over time.
Yeah. Well, Dad, I need to take a very quick break. My apologies for interrupting your train of thought, but when we come back, we'll talk more about how life insurance could be used as a retirement vehicle to supplement what you already have. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking this morning to Phil Snyder. He's also my father. He is a senior vice president of the L. Warner Companies, Inc. Dad, thanks so much for staying with us this morning.
Sure, Jeff. Happy to.
All right. A lot of people out there get their life insurance through their employer. It's a benefit that you can sign up. It's a voluntary benefit you can sign up for. Is there a way to convert? And by the way, when you do that, you're able to be subsidized in terms of the premium, actually can bring the cost of the policy down. I don't have to tell you, you know this very well. But what does that mean for people who are looking to use whole life insurance, universal life insurance, as a means for retirement? Do they have to convert out? Can they convert out? What are some of the ways to go about doing that, if possible?
Okay. Well, typically, and there's, of course, exceptions to every rule, but typically, employer-provided life insurance is what we call group term life insurance. It has no intrinsic value. It has no cash value. It's a pure death benefit. Those plans come in all different shapes and sizes. Some are very rich plans, some are not. But by and large, those are term policies. The coverage goes away when you leave that employer or when you retire. There may also be a supplemental plan that's optional where you can buy additional insurance. The big advantage of those plans is that they tend to be guarantee issue, which means there's no underwriting, there's no medical requirements to qualify for the coverage. But when you leave your employer, typically you're given a guarantee to exchange that term policy for a quote unquote cash value or permanent policy. Those policies really are only attractive for those who otherwise couldn't go to the market to buy insurance at a competitive price because of health reasons, for example. So for those who do have health issues, it may be advantageous to convert a portion or whatever is allowed to be converted from your group term insurance. But by and large, those plans are going to be very expensive and they're not going to be available or ideal for accumulating cash for post-retirement needs. So that's kind of a thumbnail of what those plans are entail.
Yeah. I want to skip back to something you talked about at the very beginning of the first segment, which is taxation. So many people in a 401k or an IRA or a similar vehicle know that there are penalties to withdraw. You have to be 59 and a half, although there might, and then the RMD age right now is 70 and a half, although it looks like Congress could be changing that. We have to wait to see what happens in the Senate, et cetera. But from a taxation perspective, say you have a 401k or an IRA and you have this benefit, I think you said, and I want to clarify, you can take out money of the cash value tax-free. Is that correct?
Of a life insurance policy.
Correct. That's what I meant.
Yeah, typically what you would do if you want to, let's say you're 40 years old, you have children going to college in 10 years, and you want to save some money. You may want to put some money into a cash value life insurance policy with the thought in mind that you could access it in 10 years to fund some of their education. Normally, you would then withdraw money from the policy, not to exceed an amount not to exceed the total premiums paid into that point in time. And if you want to take out more money beyond that, then you would borrow the money from the insurance company out of your policy. So money is available. It's just a question of when and how you access it. But if we're talking about retirement and you're a 40-year-old, for example, you could let that money sit to your 65 or 70 years of age and let it just grow and grow. And if it's growing, let's say hypothetically 4, 5, 6% or more per year, you're going to build a lot of money to be available later on in life. So that's fundamentally the concept. Now there's 100 different ways to do that in numerous different types of products. So that's where the advice of a competent financial advisor and or broker comes into play. You need to pick the right product. You need to understand the product, how it functions, what its advantages are, and what its potential pitfalls are. So you're comfortable as a consumer in buying the right product that's affordable and that's likely to produce the results you want long term.
Phil, Dad, there are hundreds of thousands of brokers and advisors out there. What do I need to look for? You can't service that. Unfortunately, you and the water companies can't service them all. So what do I need to do when I'm out looking for somebody to help me with this? Because I get the feeling, one of the hardest parts of making, as you said at the beginning, is finding the right person to help you through this. So how do I find the right person with the right designations and the right expertise to help me with this?
Okay, there's probably innumerable ways to do that, but maybe the most simple way for most people would be to seek out someone whom they look to as being a professional type person who has some education in this area, who probably has an existing relationship with a financial advisor or a broker, who could then make that recommendation for that individual to seek out counsel with that particular broker or financial advisor. That's the most natural way. So just talking with your employer, your friends, or other people who you interact with, who you respect from a financial perspective, who could be helpful to you. You could also call your local chapter of the Life Underwriters Association. They would give you a list of people to talk with. You could call the local Chartered Life Underwriter Association. They would give you lists of people to talk with as well. So there are lots of ways. And if you don't have a relationship, then I would suggest you find 2 or 3 people to talk to. Don't just take the first one who comes along. That may be your ultimate choice and it might be the best one, but you should get input from several people if you haven't yet forged a relationship with someone.
Yeah, I think that is the starting point for so many people on a multitude of issues, whether it's life insurance, an IRA, retirement, investments, whatever, estate planning, right? That is, you need someone who's got the experience and expertise, and finding that person for many people can be very challenging. Well, Phil, Dad, thanks so much for joining us on the program. We have to cut it off here. We don't have enough time to give the topic that much justice, but I think people walked away with something really helpful for them. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
All right, Jeff, my pleasure as usual. Good luck. Talk with you soon. Bye-bye.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, and drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content? Search our archives. We'll check out our website and our streaming partners like Amazon Fire TV, Roku, Samsung, over 100 different streaming platforms. We're back again tomorrow for another edition of BRN AM. Until then, I'm Phil Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
But if you're tired of the same old...
Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a tax doctor now for a tax emergency analysis.
Call 800-224-6439.